What's up, everybody? Welcome to Top Growth Financial. Today we're going to be giving you our top 3 stock picks, and today we're just going to go ahead. We're going to get started with them. And the first one we're going to go over is Disney, and this is a great company. And we're going to start off with the technicals. So as you can see, Disney right now, it's sitting at $178.18, and that's up about 59% of the year. So that's a pretty good return already because it dropped after COVID hit, because a lot of people thought, hey, people aren't going to be going to the parks, so they're going to lose revenue, but that's just not true, as Mitch will tell you later. So now I brought up the 5-year chart, and as you can see, it dropped all the way to $85.98. And it bounced back right after that, which just shows how consistent they are as a business, because it dropped for the pandemic, but so did everything else, and it bounced back very quickly. So that just shows that they have more than just a theme park. And now we're going to get started with the technicals. And we're going to go pre-COVID because these numbers just show a little bit more about what the company has done. The numbers right now, they're a little off to what they normally are over the past. They're still doing really good. So the first thing we want to look at is their PE ratio. And it was at 13 before COVID. And also the return on capital was at 15%, which both those numbers are perfect. That's exactly where we wanted them to be. It's exactly what we taught you in our beginner's guide to the stock market. They've also had a very steady growth in revenue. And in 2013, they were a little over $11 billion per year in revenue, and all the way up to 2019, where they were at $21 billion in revenue. And it was a steady growth in between those years as well. And also, Disney is not just a theme park business. They have their hands in a lot of other things. And I'm just going to tell you about those right now.
Okay, so now we're going to do a further breakdown of what Disney is, who they are, and what exactly they do as a company. Because as Josh just stated, they're more than just a theme park and Mickey Mouse. So to start out, Disney Plus. They just came out with that a little over a year ago and been very successful so far. They had 28 million subscribers in the first year. To give a comparison, right now Netflix has 60 million subscribers, but they have had their streaming service for 13 years. So they have half the subscribers, but in terms of growth, if they can even just keep a slow growth rate, they'll be competing with Netflix. Next thing we're going to look at is their licensing agreements, which has brought them a lot of revenue over the years. And the two biggest ones are the Marvel and Star Wars franchises. Those have both been great. In fact, they're still making Marvel movies. But as I said, those have both been very successful and continue to be successful and bring in revenue for Disney. Next, I want to talk about their acquisition of Pixar. So a lot of people don't know this, but Pixar was actually their own separate company until 2007 when Disney bought them out. So what happened there was Pixar started to compete with Disney. They were a very successful company. They were well ran. So instead of spending those extra resources and money to compete with Pixar, what they did was, like I said, they bought them out. And the agreement that they had was that Pixar was going to continue to run their company the same way they have been. They kept the name and all because Disney recognized that they were a successful company. So let's let them keep doing what they're doing, and we're going to bring in revenue from them as well. And that's turned out great. They've made a lot of money off of Pixar. And lastly, as I said earlier, they're not just in the cartoon business. They've been able to stick their hand in basically every facet of the entertainment world. And that includes the fact that they actually own ESPN and ABC. So many different forms of entertainment, including sports with ESPN. So the fact that they're able to be successful in basically every form of entertainment just shows how great of a company they really are.
And now I'm going to take you away on the tip ranks. And this is actually a really cool website that I found. Just goes over the analysis of each stock and takes you in a little bit deeper of what's going on in that company, the different technicals that would be hard to find on your own. So as you can see, the analyst rating consensus is that it's a strong buy. And that's out of 21 ratings. And there's no sell rating. So there's 3 holds. But it's basically saying if you already have the stock, don't sell it. So no matter what, it's not a sell. But most people are saying buy right now. And as you can see on the upside, there's a 17.82% upside. And that'll take you to almost $210. And right now it's sitting at $178. So that would be a pretty nice gain over the next year. Because the average return on investment in the stock market is about 10%. And as you can see, their SMART score is at a 9 out of 10, and that's going to outperform 9 out of 10 stocks. And their consensus is a strong buy, sentiment is bullish, last 7 days is bullish, their sentiment is very positive. So overall, we just think this is a perfect stock for you to buy. If you don't have it in your portfolio already, I would just go for it. And we're going to add it right now into our YouTube portfolio that we're going to be showing you at the end every week, so you can see how the portfolio is doing. And if you want to get started investing, to see what we're invested in and how it's doing, so that you can get an idea of how it's going to perform in the long run. The next stock we're going to talk about is in the steel sector, and that's like the hottest sector in the stock market right now. We're going to get started with United States Steel, and the ticker for that is X. And as you can see, the stock chart for the last year has been up a lot. It's up 204%. But when you take a look at the 5-year chart, you can see that their peak was at $45.39. They did at one point drop all the way down to $5.29, but they're bouncing back right now. So we think this is a perfect buy, and especially with the steel sector taking off. Their earnings are increasing. They're not incredible, but they're pretty good, especially for this sector, and this is a super hot sector right now, so this is definitely something we think you should be investing in. So now I'm just going to get started with the technicals and take you away on those.
Okay, so the first thing we always like to look at is the PE ratio. Right now it's around 3. I know it doesn't sound great, that's less than that range that we said we'd like to look at, it's less than 8, but we're going to look at where it's come from. And in the last year, since 2020, it's been up 8.5 points. So that PE ratio got down to as low as -5.5 last year. They've really been surging since then. Up 8.5 points in 1 year is actually pretty good. So that 3 PE ratio looks a little better now than if you just look at it and see 3. So it's more about the trend that we're looking at than the exact numbers. And the same thing goes with their return on capital. Right now it's -7.5. I know we never like to hear that negative, but again, up 15% from last year. That's a big jump. So again, that trend, it looks really great. The number doesn't look great, but we think in the next quarter or two, hopefully we'll be positive, but we really do think it's going to continue this trend, especially like Josh said, with how hot this sector is. We really believe in this one. And lastly, we're going to look at their earnings per share, and I think you're going to like these numbers. So last year, they had an earnings per share of -2.67, and that's by million. So -$2.67 million per share. 4 quarters later to right now, we're finally profitable. So this past quarter, they reported earnings per share of 1.08. Again, another big jump. Almost $4 million per share increase from the last 4 quarters. But the biggest thing being they're now finally profitable. That's a great sign, and we're looking forward to even more growth in the next couple quarters.
Okay, so now I'm going to take you away on the tip ranks for United States Steel. As you can see, the analyst rating consensus is a 6 for this stock. 2 buy, 4 hold, 0 sell. So a lot of people are saying to hold it if you have it, but 2 are saying buy it, and we're going to be with them. As you can tell, that there's a big upside for it. There's a 12.9% upside, but honestly, I think it's more at a 20% upside. We'll see how that holds up. Their SMART score is an 8 out of 10. So they're going to outperform 8 out of 10 stocks according to this tip ranks analysis. And the analyst ratings rated as a moderate buy. The average price target is 30.20. There's a very positive sentiment around it, along with the rest of the steel industry right now, with that bullish sentiment on the blogger opinions, and the news sentiment is very bullish. So everybody thinks that this is going to outperform the market. And then lastly, with the technicals, they've been very positive with a 245% 12 months change, which normally something that's been up that much during the last 12 months, we would say stay away from it, but it's so hot, and it also is down from its all-time high, almost 50%. So it has a lot of room to grow, and we think it's going to get there eventually. So now we're going to go over our third stock pick, and that's going to be Alibaba. And this one has been basically dead even over the last year, as we're going to show you in the chart. So the growth has been pretty consistent over the last 5 years. It's gone up all the way to almost $310 at one point, but now it's back at $214.14. But over the last 5 years, it's still up 184%, which is incredible compared to the rest of the market. And that's an average of about 37% a year. Compared to the 10% year average, that's incredible. But over the last year to date, it's gone up literally nothing, like I said. But here are the reasons why. So over the last year, their stock price has just been pushed down by the regulations that the Chinese government has imposed on Alibaba. And a lot of this has to do with their founder, Jack Ma, who's a big name, but he kind of went into hiding for a little bit. Nobody could really find out where he was. But when he popped his head back up, everything was fine. Those fears were relieved because he really is the brains behind this business. He created the business. So it's very important that he is there. But it also dropped a little bit because their earnings for the fourth quarter were a little bit under the expectations. And whenever that happens, the stock price will drop a little bit. But there's really no reason for that stock price drop because their earnings have been going up every single quarter for the last 4 quarters for a total of 77% with that increase. And it's really no surprise that they have such an impressive growth record because they're basically like Amazon in China. They're an online e-commerce company that people can just go on there and they can sell stuff off that platform, just like Amazon, and it's done very well. How well? Well, Mitch is going to tell you and take you over with the technicals.
Okay, so their current PE ratio is 26.77. That's not a bad number. It's just outside of that range that we said our 25 is usually that cutoff. But we like this number for a reason, and that's because they have had steady earnings growth, like Josh was saying before. So the more those earnings grow, that PE ratio is going to decrease. Like it actually has been the last couple of quarters. It was much higher before. It's down to 26, and we actually expect that to keep coming down as those earnings grow as well. And with those growth in earnings, we actually expect to see that stock price go up as well. So the PE ratio is actually pretty good right now when you really break it down and look at it closer. Their return on capital right now is just under 12%. That's good, not great, but as we said in our first video that we like to see at least double digits. So it meets those requirements. So now we're going to take you through the tip ranks. Okay, so as you can see here, the analyst price target on Alibaba is $301 in the next 12 months. That's a nearly 41% upside. It has a strong buy with 26 total ratings. 25 of them say buy and only 1 says hold. 0 say sell. If you look over here towards the bottom right of the screen, you can see the lowest price target. And even that's $270. Even that would be a big gain from where we're at right now. And here's a couple of those 26 total analysts that rated Alibaba. And a lot of them are from credible companies. You can see here Citigroup, Merrill Lynch, and a bunch others. So here you can see they have a 10 out of 10 smart score, meaning a lot of these analysts think Alibaba is going to outperform almost every stock in the market. Look over here at the analyst ratings at the consensus, it's a strong buy. Down here at the sentiment, you can see very positive, also very bullish in the last 7 days. Even over here at the hedge fund activity, you can see that the trend has increased in the last quarter. So overall, we think Alibaba is a great buy right now.
Okay, so that was our top 3 stock pick video. We hope you liked it, and we hope that you punch the subscribe button as always, that you give us a like, and that you come back for our next one. We're going to be showing you how it performed over time, and we're going to try to make a lot of money together.